This is the Cash Value Solutions Podcast, where your hosts, Jason Pohlmeyer and Kyle Mann, shed light on little-known money truths to help you take control of your financial future and become your own banker. Subscribe, rate, and review the show, and check us out at cashvaluesolutions.com.
Hey everyone, welcome back to the Cash Value Solutions Podcast. Kyle and I are going to continue our mini-series, and we're on pros this week of whole life insurance.
Yep. We are going to start off talking about the guaranteed death benefit and the guaranteed cash values that come along with whole life.
Yeah, so let's start off with death benefit since you mentioned that one first. Once you go through underwriting, receive your underwriting class, and are issued a whole life policy, as long as you keep up your end of the bargain, which is paying the premiums, the life insurance company contractually has to honor that death benefit. It is enforced for your whole life.
And we're aware of zero companies that haven't honored that death benefit.
Yes. That is a pretty amazing statistic.
Absolutely, yeah.
That is something that you don't have with term life insurance. I'm not saying that if you don't, or I'm not saying that if you pay your premiums, they won't pay the death benefit. What I'm saying is you don't know that you'll have that insurance for your entire life.
Yeah.
That's strictly all I'm saying. I'm not saying that there's something funky going on with the term at all.
You die during the term, it'll be covered.
You're absolutely going to have a death benefit paid out.
Yeah.
But for your entire life, never have to go through underwriting again.
Mm-hmm. You can develop any type of mortal illness, and it doesn't matter.
Yep. That's extremely powerful.
Yeah.
And your rate doesn't change either. Your premium doesn't go up because you get sick 10 years after you applied for this thing.
Yeah. Once we set your max premium, it can never be. You can't pay more than that. You can pay less.
Well, you could pay
flexibility.
more, potentially, but you just cause a modified endowment contract.
Sure.
More than likely.
Yes. Okay. If we want to stay within the MEC ranges, you can't pay more.
Mm-hmm.
So.
Yeah. So that's really powerful. And whole life insurance does that. It also has guaranteed cash value. And this is beyond powerful when you start thinking about guaranteed cash value. And we're going to link dividends in with this. Okay. So, Kyle, when we show people an illustration, we can see what the bare minimum is that this policy will perform at.
Yeah, with no dividends.
No dividends ever being paid, maximum insurance expenses being charged.
Worst case scenario,
we can see at a minimum what the policy will perform at.
Mm-hmm.
The company is on the hook for that, okay? That is your guaranteed cash value. As long as you pay the premiums in the amount and at the time that we're showing them being paid in the illustration, those will materialize at least at that level.
Yeah.
Okay? This is the really, really powerful thing. Okay? Now, let's say a dividend has been paid to the policy. That is added to the guaranteed cash value of the policy. And now, forever into the future, the guaranteed cash accumulation of this policy is going to be greater than it was from when this policy was issued.
Yes.
And it will forever and always be that way because once a dividend has been paid, it cannot be taken away from you.
No.
It cannot be taken away. The only dividend that isn't guaranteed is the one that hasn't been paid to you yet.
Yep.
Okay? That is unbelievably powerful because there are so many things where you can accumulate wealth and capital. But at some point in the future, they have the possibility of losing value.
Yeah.
Whole life insurance is immune to this.
Yeah. I mean, what other things give you this guaranteed, at least the guaranteed value? It's not like it's flashy. I mean, if all these policies ever did was perform at the guaranteed values, there's probably better places to store capital.
We wouldn't be talking about this, at least not nearly as passionately as what we do right now.
Yeah. But no, it's awesome to see that there is a guaranteed level. I mean, and each year that dividend is paid, you can get a enforced policy illustration and look at your guaranteed levels, and that guaranteed level will rise because it accounts for that dividend that you just received.
And somebody that is inexperienced might tell you, like if they're reviewing your policy, say that you guys had a policy with us. I mean, this is hypothetical, but say you guys have had a policy with us for 10 years and for some reason you aren't getting along with us. You don't like or trust the advice that we've given you. So you go and have somebody else look at this policy and they say, well, man, this thing isn't really doing very good. It's just performing at the guaranteed cash value level. And okay, so that would be a very good indication to you that person does not understand whole life insurance because the cash value, once a dividend is paid, it becomes part of the guaranteed cash value.
Mm-hmm.
And so if we add 10 years worth of dividends on to the cash value, the guarantee is way higher than what it ever was, but it is the guaranteed cash value now, so it looks close to what the non-guaranteed is.
Sure.
Next thing is, we briefly touched on dividends, but this is something that whole life insurance is criticized for. People will tell you, dividends are bad.
Because it's return to premium because they're overcharging you for life insurance.
Sure. And I wish, I don't have that Northwestern Mutual policy in front of me right now, but I specifically remember that the dividend was nearly 10 times what the annual premium was in the year of the annual statement that we were looking at.
Pretty powerful.
And I would be willing to bet that policy has had far more dividends paid to it than it has had in premium dollars actually paid into it. So, yes, it is a return of premium, but you have to realize that there is also an earnings component to that dividend as well. So it's not just a return of premium, it's a return of premium plus what the company has earned with that money as well.
And life insurance companies are great at being profitable.
Absolutely, they're great at making money.
Yeah.
Dividends also, they tend to grow larger as policies age. Even if dividend rates may come down, you typically have enough cash value that you keep accumulating, so you're earning dividends on a greater size bucket of money, so they continue to get larger. And you'll oftentimes hear people talk about how policies become more efficient the older they get, is because they're gaining more value by a larger dollar amount each year as they age.
Sure.
Dividends also are unique because with mutual life insurance companies and it being classified as a return of premium, the dividend is not taxed when you use it to purchase paid up additions. It is also not taxed when you take it in cash until you exceed your cost basis in the policy. That is not the most efficient way to use a dividend, but it absolutely is something that you can do.
Yeah.
And it's also worth noting that dividends paid, for instance, on stock, even if you would use them to reinvest in the stock, you have taxes due on them. So this is a significant tax advantage, how dividends are paid to life insurance.
Yeah.
Specifically, mutual life insurance company dividends.
Which is why one reason why we like to use mutual insurance companies.
Absolutely.
So,
dividends, that is a huge driver. And if we didn't have that with whole life insurance, Kyle and I likely would not be talking to you on this podcast.
Probably not. Probably not.
So
they are important, and people can say all they want that none of that stuff's important. It's just about control of capital, which control of capital, very important. Dividends, really
amplify.
Bring it together. Make it worthwhile. Make this the best place to store and warehouse that money.
And so let me ask you this. Why? Okay, so I know the answer, like we're of a little different opinion than some people in the IBC community, but why do we believe that policy performance absolutely has something to do with why we use whole life insurance.
Well, if you're not in a better place financially from using this system, then you might as well be using a savings account, I guess I think.
Right.
If
Yes.
you're not getting a dollar benefit for it, then why use it? Yes, there's protection. So if that's of the importance, then that needs to be considered. But if you're looking for a spot,
Specifically to accumulate
Yes.
capital.
that is what we're talking. If we want to talk about IBC using the banking function, like you need capital for that. So it makes sense to put it in a place where you put capital, but then you have access to more capital than what you put in, right?
Yeah.
I mean,
And that's why, we believe that it's important that at some point in time you absolutely break even and you absolutely have more cash value than what you put into the policy.
yeah.
And some people in the industry definitely don't put as much value on that as we do. But we believe that is absolutely important because at the end of the day, if it takes you 20 years, for instance, to get back as much cash value as you paid in premium, have we done you a service? What could you have been doing by accumulating that capital in a savings account or checking account or some other thing and been doing, with all that money?
Yeah.
Because you didn't have some illiquidity.
If your goal was capital accumulation and we sold you a policy that took 20 years to break even, I don't know how we could say that we.
Personally, I could not morally justify
No.
the fact that I sold a policy like that for that reason.
Yes, if your goal was death benefit now and we accomplished that goal of death benefit, and
That's
it took
totally different.
absolutely different.
Totally different.
Yeah. So, and like we say all the time, we cannot speak in absolutes, one size fits all, policy design or strategy. It just doesn't work. Like you can't do that with everybody.
No.
Certain companies work better for certain people too. I mean, it's just the nature of the game. And
Okay, so here's a really simple example. If you want a lot of death benefit protection for an affordable premium, you're going to either use term insurance or like a pay to age 121 life insurance policy because they're going to have lesser premiums than a 10-pay whole life policy, for instance. Okay, just a really, really simple example, but there's a lot more that goes into what you want, So that's just
sure.
Everybody's situation is different.
Yeah. We need to take that into effect, and people need to recognize that. I know people in the IBC world can get hated on by other people because they don't do it the way they think. Well, the way they think they should be. Well, if they're suiting their clients' needs, I mean, how are you to say that they're wrong?
And so to get really back focused on control and liquidity, this is where we have policy loans where we have access to this money at any time we need to without going through some lengthy approval process. For me, that is such a massive advantage being in the agricultural world as well. Because there's opportunities that come up and you absolutely have to be on the ball time-wise.
Well, see,
to take advantage of it.
That's one problem when we get caught up in rates of return is we don't know what type of value to put on that.
The external?
Access. Yes, the access to that capital, which then leads to an external rate of return. And yeah, right now there are places you can get money cheaper. And if it works for you, there's no problem of doing that I see anyways right now.
Me personally, I'll speak, I'm using my policy for a down payment on some land, and I have more value there that I could be using for an operating loan, but I want to have access to as much of my capital as I can, so I'm using somebody else's money right now for my operating loan. Yeah. And I'm getting it for a lesser interest rate. I'm paying them less to use it than I would my policy.
Mm-hmm.
But my main reason being is I want to have access to capital for opportunity.
Sure.
And that comfort of having a cushion,
Yeah, that's worth a lot as well.
Absolutely.
As we've come to find.
And, another thing, this will kind of wrap this up, and this goes along with policy loans and stuff, is how you're able to withdraw money on a favorable basis from a cash value life insurance policy.
Yeah, which is called FIFO, which is first in, first out.
Right. And so what that means is the first money that you paid in, premium, is the money that you can take out. So you don't have to withdraw gains like you ordinarily would from a different type of vehicle, such as a 401k.
Yep.
You are able to, if you have $100,000 of cost basis in this policy, it's been in force for 30 years, and you have, say, $350,000 of cash value, you could withdraw that $100,000 first, and then, withdraw that $100,000, not have any taxes due, and then you could borrow against the remaining $250,000. And this is where we talk about how you can access the money without paying taxes, so people call it tax-free.
Mm-hmm. The biggest downside to that is, though, so first in, first out, those first dollars that you put into the policy bought the most amount of death benefit.
Paid up additions.
Yes, and the paid up additions. So then you're going to be surrendering all those paid up additions for depending on how much you take out.
Sure. And really, in Kyle and I's work, that strategy where we talk about withdrawing is really just for a retirement income play. That's not how you want to use the policy in an infinite banking type sense, where you're accumulating capital to take advantage of opportunities.
Yeah, it starts out as people not caring about the death benefit and stuff like that, but then once you see it being decreased, like you don't really want that.
It's like, whoa, wait a second, maybe I don't want to do it like that.
Yeah. Which the great thing about this is there's a lot of flexibility, so we can do
you don't
a lot
have
of
to
different
withdraw
things.
that first $100,000. You could borrow.
Yeah. So I guess that should be another pro that we didn't talk about, is the flexibility.
Absolutely.
That's probably one of the biggest things. I mean,
when you design a policy for maximum cash accumulation, not only do you have more cash, but you aren't committed to such a large premium.
Which then allows you to start with a bigger premium, I believe.
Oh, absolutely.
So, I mean, if you have a $50,000 premium, like that can be a daunting premium. But then if you know that you can pay $20,000 as a minimum, like that's a pretty big relief. I mean, if things don't go right, but yet you have all that room to fill if
maximize your policy.
Yeah. So
that's huge. And not only that, but I mean, if things would go really bad and you have a tough year, if the policy's been designed in a way to maximize cash value, you more than likely wouldn't even have to pay a premium in year 2 to keep the policy in force.
Mm-hmm.
Not that you want that scenario to play out, but it would
Worst
be an
case.
Option available to you, and to still have your policy remain in force.
Yeah.
I mean, there's a lot of things that we could touch on. I think these are the biggest players as far as advantages or pros.
Sure.
To the list. So that's what we're going to keep it to.
Yeah, and if you guys have any questions about any of this stuff, shoot us an email, and we'll get any of those questions answered for you.
Yep. So thanks for tuning in this week, guys. And this was our little mini series on pros and cons of life insurance.
Yep. Hope you guys enjoyed it.
This was the Cash Value Solutions Podcast. Remember to subscribe, rate, and review the show. Check us out at cashvaluesolutions.com. And don't forget to tune in next week.